Good evening. I'm Colin Harrington, CEO of Zephyr Energy. I wanted to thank TPI and Vox for hosting us tonight, and especially thanks to all of you who are tuned in and made it this far. I hope to make it worth your wait. I'm Colin Harrington. I'm CEO of Zephyr Energy. Tonight, I want to give you a sense of the background of our company and my involvement and what we see as the investment opportunity, tell you a bit about our mission and team, take you in a deep dive on our Paradox Basin asset, which is the primary asset in the company, and how we're developing that. And then I'll give you a summary and some views on value. So Zephyr Energy is a oil and gas company focused on responsible asset development in the Rocky Mountain region. Many of you probably have known our predecessor, which was Rose Petroleum. In May of 2019, I became involved in Rose as an investor first. The former management approached my partners and I, who ran a private equity firm in the US. They approached us with a proposal to make an investment in and provide some management support, board support to the company. So we did extensive technical and commercial diligence on Rose, principally and particularly on the Utah asset, but also on the platform itself. And we elected to make an investment. I am now serving as CEO of the company and represent about 20% of the shares outstanding. We've put $1.5 million of our own capital into this company, and we're looking for some like-minded investors to join alongside of us. So I want to tell you what I saw, why I made the investment in this, and what we're doing to create value in the company. So when my partners and I came in and joined the company, our thesis was predicated on this perception of a very significant valuation gap between the market cap in May of 2019 and what the value of the company could be. We saw an entry point, a market cap that was less than even just the historical seismic costs that had been spent on the Paradox Basin Utah asset, not to mention the other leasing and development costs that they had accrued over the years. We also saw, because of that earlier development activity, there was an accrued tax loss asset of almost $15 million, which could be used in the future to acquire production or near-term development assets if one chose. And then when we looked at the Paradox Basin asset and just the Cane Creek Reservoir in that asset, we saw significant value there. To put it in perspective, Gaffney Klein did a CPR on the asset in 2018. At a $45 oil price, they ascribed in the Cane Creek Reservoir about $50 million of value. We think that's conservative, but that's significant upside from where we are today. There are also 5 additional reservoirs that historically have not been targeted in this area that we think there could be significant upsides and value for. So we've come in to help bridge this valuation gap. We knew there was going to be a lot of work. The former company had lost momentum in their efforts, and everything we've done since then has been a bit below the radar, but to try to turn this around and realize the difference between market cap today and the potential true value of the assets. So what we've done since 2019 coming in, we've changed the board. There are 4 new members of a 5-person board. Majority of them are non-execs. Everybody has significant turnaround experience and energy sector experience, a deep reservoir, and I'll walk you through who we have now. The management team is new as well, significant onshore experience in the US. We've tightened our focus significantly. Many of you might remember, various sectors and geographies within Rose. We have distilled that down to a singular focus on oil and gas in the American West. We restructured the Paradox asset to make it lower cost and focused on the core 3D seismic area. We closed a number of businesses and subsidiaries. And then we spent a lot of time partnering with what we felt were world-class institutions who could help us bring knowledge and visibility to this Paradox Basin asset. We've dedicated a sufficient, certainly an extensive amount of time and resources to our basin modeling, both in the Paradox, but also in areas where we'd like to grow through acquisitions. We've aligned the board with shareholders. As I said, we've purchased about $1.5 million worth of shares, and we now own a 20% stake in the company. And to cap all of this, we changed the name of the company and we aligned it with our philosophies as individuals, which is really that to develop oil and gas, you must do it responsibly and with a strong ESG focus. So going forward, as I said, we're only focused on responsible oil and gas development in the Rocky Mountain area. All of our efforts right now are on developing our Paradox Basin asset, which is happening in the near term. We're spudding a well this month. And we're very excited about that. We'll walk you through what we're doing there. We're also continuing to leverage other organizations, large organizations, operators, investors, as well as the U.S. Department of Energy and the University of Utah to help us develop this asset. We will look for acquisitions. It's a good time to be in the market, especially when you're a clean, no debt company like we are. And we're focusing just to be as strong and proactive as we can with our stakeholders and local communities in the areas that we operate. So now let me walk you through the mission and the team. And this is the part of the presentation that doesn't make me that popular with my peers in the US. But the E&P sector in the US over the last decade has been disastrous, both economically and environmentally. When you look at it from a share price standpoint, even factoring COVID and the commodity price cycle, you don't account for the underperformance that you've seen. I think there are a lot of factors into this, and I don't want to oversimplify it, but the industry here was driven for a long time by focusing on production volume growth rather than economic growth, cash flow growth. Management incentives were aligned with acreage and production growth rather than cash flow. A lot of focus on acquiring acres, but not necessarily well-located areas. And we believe that location is key to making money in this business. And we're highly focused on being in core areas in the basins in which we'll grow. And then obviously, throughout you had very easy access to debt, and we're seeing the consequences of that now. Massive over-leveraging, wave of bankruptcies across the industry, and a lot of zombie companies that might not be bankrupt, but don't have the capital to drill out or to grow. Similarly on the environmental side over the last decade, we've seen a lot of harm being done. Again, just scratching the surface, things like flaring of gas. You're just flaring carbon up into the air, and you're losing the associated revenue that you could have from that. Very random emissions monitoring, sporadic emissions monitoring, poor local relations, especially in areas where development is trickier, places like Colorado. We see practices like freshwater fracking in areas of drought. These are all things that we believe are both harmful economically and environmentally. We do things differently at Zephyr. Our ethos, we will be responsible stewards of your capital, and we will be responsible stewards of the environment. From the capital standpoint, we lead with science first, and as I said before, location we feel is the key driver of value in this business. So we look hard at the rock underneath the land in which we're investing. We're going to maintain low fixed costs. We're extremely averse to any debt. We'll be very, very conservative on the leverage front. Management incentives will be aligned with share price growth, not bonuses for delivering acres or production. And our goal is to return capital to shareholders when we can. And obviously the incentive to do so exists because the board and management are major shareholders in this company. Similarly, on the environmental side, we're not going to flare. We're not going to freshwater frack in areas of drought. We're going to use best practices and best technologies to do things like emissions monitoring. We'll be a good partner in our local communities. And lastly, and this is very important, we've got an independent board who provides strict oversight to the management team. They bring experience, they bring relationships, but the key thing is the oversight part of that equation. You can go to the website to read the bios of the board we've assembled. I'm not going to go through it all, but just to give you some highlights here. Our chairman is Rick Grant. He used to run one of the world's largest LNG companies, Suez Global LNG. He's done a number of turnarounds in the sector, great experience at multi-billion-dollar companies. Tom Reynolds is currently CEO of Wellford Energy. He's got significant AIM experience and significant private equity experience, 25 years in the sector. Similarly with Gordon Steen on the finance side, he's been in a number of AIM turnarounds, has had a great track record at those, and recently sold Columbus to BPC. So they are our independent directors. From my standpoint, I've been in the sector 25 years. Most recently was a co-founder of an E&P company in the DJ Basin in the Rockies, which we went from startup to farm out to production in under a year, and then we successfully monetized that asset. Chris Eady provides wonderful continuity between Old Rose and Zephyr. He's run a tight ship in this company since 2014. This is part of the reason why it's clean, low cost, and no debt, and he's got a lot of experience in the sector. Gregor Maxwell heads up our technical side. He's head of subsurface, PhD in reservoir geology, 25 years experience in the sector. previously with Apache, RockSource, and Chevron, has done a great job in building out our technical capabilities. So as I said, value growth is beginning for us with our Paradox Basin asset. We also have an option to join into a horizontal development in Colorado that we expect could be drilled in 2021. Even though prices aren't where they were when we initially stepped into this, we haven't expended any capital there, and CapEx costs have come down significantly in the DJ Basin. So if we elect to participate in that when it's drilled, we'll be participating alongside one of the basin's most active drillers. And we've seen CapEx decrease by 30% and break-evens look much, much better in that basin. So it's an exciting option for us. But tonight, really, I want to talk about the immediate thing in front of us, which is the Paradox Basin. So our Paradox asset, the company historically leased a lot of acreage. We focused that down to 25,000 acres that all have seismic underneath it, modern 3D seismic. Unlike most of the active basins in the US, this is a natural fracture play. This is really important. It means there's no artificial fracking that's being used when you develop this basin. That helps cut CapEx, obviously. Sometimes you see completion and fracking costs at 50% or more of your drilling costs. Here, we think the break-evens in the Paradox will be much lower because we are targeting the natural fractures rather than having to stimulate them artificially. This is a basin that historically has been successful, but the wells that have been successful intersect with natural fractures and have very high initial rates, but substantial ultimate recoveries as well. The issue historically has been mixed results, 50-50 type success rates, because of a lack of understanding of the rock and the older technologies that were available at the time. What's changed in the last decade is immeasurable in terms of the technology. Things have moved from 2D to poor quality early 3D seismic to now modern 3D seismic, where you get a great picture of the rock underneath. Similarly, horizontal drilling has just had a step change over the last decade. Directional drilling capabilities have significantly improved as well. None of these technologies have been used in the Paradox Basin until now. We own the most recent 3D shoot in the basin. It gives us a great snapshot at where the natural fractures are. We think we'll be able to much improve on historical success rates. And then secondly, and this is really important, we've received a $2 million grant funding from the US Department of Energy to go in and drill a vertical well to obtain data, which will help us further de-risk this. This will be cores from the Cane Creek Reservoir and logs from 5 other reservoirs, which we think will greatly help us in developing this in a less risky manner. To give you some history on the basin itself, as I said, it's been a prolific basin. It's proven. It's been producing since the early 60s, 10 million barrels to date, mostly from the Cane Creek Reservoir. High rate wells are a very strong characteristic of the play. IP is above 500 barrels a day, sometimes 3 times that. But as I said, the success rate has been mixed. Early 3D was acquired in 2001 and 2011. So early iterations, not great resolution versus what we have now. But you can see to the right-hand side of this screen, as you look at the difference that even having 3D, it significantly ramped up when we hit about 5,000 barrels a day of production at the Cane Creek, with a company named Fidelity Exploration at that point. Unfortunately, Fidelity was sold. This is not a unconventional shale play, so it's really been overlooked in the years since. But we think now with the combination of our seismic and the well data that we'll get from our vertical, it's a great time to go in and re-stimulate this area. So let me talk about the grant, because this is, again, hugely important. It helps us de-risk this project and lower the amount of capital that we need to do so. And we think this is going to be extremely important when bridging that valuation gap. So it lets us combine our existing cores and logs with data that we acquire from this well at a very low cost to Zephyr. The overall cost is $3 million, but $2 million of that is being contributed in a non-dilutive grant funding. So it's up to $1 million of exposure for Zephyr. It also lets us accelerate the timeline here to development. It means we will be drilling this month in this basin. The grant details, as I said, it's $2 million. It's a project team that's working on understanding the basin and bringing visibility to it. It's led by the University of Utah's Energy and Geoscience Institute, which is one of the leading geoscience institutes in the world. It's sponsored by the U.S. Department of Energy, so they're the ultimate funders of this. And what we are doing is drilling a vertical research well. So we're not aiming for production for this first part of the well. The primary objective is to acquire the comprehensive data set, which will let us de-risk this and understand this basin a bit better. So it's logs and 90 feet of continuous core, and we're going to evaluate that data and take next steps. Now, what's really important about this, and this is why we call it a dual use well, we will be able to use the wellbore in the future to go in and use it as the sidetrack host to drill a lateral, a horizontal lateral, to go turn this into a production well. By using that, we reduce the costs of a well, of a typical horizontal lateral, from $6 million down to $3 million. So the economics on this first well, when we use it, if we use it to go achieve production, will be very significant in our view. I will give you an example here of what we're talking about. So after this black line is the initial vertical well that we'll be drilling this month. It's going to go down through a number of reservoirs called clastics here. On the seismic, they all appear to be oil bearing. It'll go all the way down to the Cane Creek Reservoir, which is historically the most prolific reservoir in this area. The other 5 have not typically been targeted or understood. And we'll drill down, we'll take 90 feet of core here, and then we'll take logs across these other reservoirs that appear to be oil bearing, so we have a better sense of what's underneath the rock. Then we'll abandon the well temporarily at this 9 5/8 shoe. Now, once that data is processed for all of this, it will allow us, if we elect to do so, by matching the seismic and the data that we've acquired, to go into the same well bore and drill down again, but this time drill out horizontally and tap the Cane Creek in a much more effective way. It'll also obviously help us understand the other clastics, the other reservoirs. So by doing it in this 2-step fashion, it's going to significantly de-risk the future development. The surface footprint will be much reduced as well. And we're actually using an existing site and pad, and our CapEx will be about 50% lower than what a typical horizontal development will be. The location, as I said, is on an existing pad. It's all covered by our seismic. It's nice to be able to reuse an existing pad and existing roadways, because we're significantly reducing the surface footprint and environmental impact. And we've got good access to oil field service bases nearby. Vernal and Grand Junction are both a few hours away. We've made good progress so far. We are delivering this project as we said. We announced it in October, and we said we would be moving towards a year-end spud, and we are on track to do so. We completed the site work and the road prep, which is what you see in the pictures here. That was completed on November 25th. We've also done all the permitting work and had everything approved so that we're now free to drill, and we announced that yesterday. Today, we announced the signing of our rig contract. We're using Cyclone Drilling. They've been around for 40 years. They are specifically Rocky Mountain driller. They've got modern rigs that are purpose-built for Rocky Mountain operating conditions, which can be harsh in the winter. This is not a cold stacked rig. It's operating right now. It's in Wyoming, and it's going to be mobilized to Utah in the coming days. This is also a team that's drilled strat wells for the DOE before, so they're certainly an acceptable partner from that standpoint. We had 6 different rig companies bidding on this project. We were very gratified, and we're excited about the process we went through, and we think Cyclone is going to do an excellent job for us. They have a fantastic safety and operating record here. Similarly, we're funded to do this. Our partners at TPI did a great job for us in October. They raised 2.25 million pounds. The offering was oversubscribed. We had a great range and support from existing investors as well as new and institutional investors. This funds our maximum obligation alongside the grant for the 16-2 well, and it also allows us to have options in the future. So it did unlock our $2 million in grant funding. We've received the first 600,000 of that already, and the second 600,000 was triggered by the rig contract today. So to summarize this all, and what gets me excited, we, for $1 million of commitment that we've made to this well, we unlock a $2 million grant, which is non-dilutive capital, and we get the benefit of all the money that Rose spent in the past, including $3 million on seismic, their lease costs, their development costs. We get to utilize that in an effort to try to take our current market cap at 5.9 million and bring it closer to what we think the real valuation of the Cane Creek should be. As I said before, $50 million PV10 on a 2C basis at $45 oil flat. That was Gaffney Klein's view of it in 2018. We think with the advances in directional drilling, with the seismic we have, and by de-risking that, we've got significant potential just in the Cane Creek alone. But as I said before, we're also getting data on the 5 other reservoirs that look good on the seismic that we'll now have logs from, and we see significant upside from here. So, from that standpoint, what you should expect next, we are sticking to our timeline. We are going to be mobilizing the rig to the well site and spudding this prior to year end. There will be a 30 to 40 day drill time post spud. And then from that period, there's about 1 to 3 months of data processing and evaluation. And at that point, we'll decide whether to go in and use this wellbore to sidetrack it and drill out a production horizontal well. In the meantime, we are very active in looking at other acquisitions. The market, as you can imagine, in this part of the U.S. is distressed right now. We think there's a variety of acquisitions that are rising to the top of our screening for production or near-term development in our areas of focus. And remember, we've got a big tax loss asset that could be highly beneficial when marrying this with production or development. We've got a great team who's going to deliver value in this marketplace. There's no debt in the company. We don't have any underwater production, no sub-economic production, no inflexible capital commitments beyond the 1 million that we are committed to spend at 1642. And I want to reinforce this one more time. We will always work to fulfill the core mission of being responsible stewards of investors' capital and responsible with our environmental footprint. And our capital at 20% of the total holdings is alongside yours. So with that, as I said, we're looking for like-minded investors who would like to come along with us on this ride. And I'm happy to take questions from here if you have any. So thank you very much for your time. And below is my email. I'm happy to speak with investors at any point. So please reach out, and happy to answer questions now. Thank you.
Excellent presentation, Colin. Thanks for joining us, and live there from Washington. Like I said, the light there is phenomenal. I thought that was one of those fake backgrounds you see on Zoom and stuff. I thought, wow, that's amazing. But thanks for joining us.
It's a funny American day, Justin. So thank you. Thanks for having me tonight, your time.
Yeah, unlike over here, it's dark, wet, and cold. It's a classic sort of English winter night. Okay, so let's get into the questions. Here we go. First one. You're now fully permitted to begin drilling at the Paradox. If you do start drilling this month, when can we expect the first results?
So the drill time is about 30 to 40 days, depending on the conditions you encounter as you're going down. But we'll have a 30 to 40 day drill time, and then we'll take the logs and the cores, and we'll go through the analysis and the evaluation of them. Some things right away, but there will be a level of sophistication to the analysis that takes a bit of time, and this is where our partners come in. We're partnered with the University of Utah's Energy and Geosciences Institute, absolute world class, and we've got Schlumberger who's going to be doing processing for us as well. So they'll do their work. It will generally be 1 to 3 months before we have those high quality, the high quality and top notch analysis, which we'll use to make the decision, do we go forward with the horizontal or not?
Okay. Assuming the initial well goes to plan, what levels of production would you expect from the planned horizontal extension?
So, what we've seen in this immediate area is that IP rates can be substantial when you hit those natural fractures. So, I'll give you an example. The Cane Creek 12-1, which was drilled in 2012 by Fidelity, they hit 1,400 barrels a day and were inhibited by their infrastructure there. So you can see really big numbers. We generally would say 500 barrels a day or above would be a great result. And that's what all of our models are based on. That's what Gaffney Klein did their work on. But, certainly you could see bigger rates if we intersect the fractures the way we hope to.
Yeah, okay. Next question here is, you could have backed any number of US-based oil companies. Why did you choose Rose Zephyr on the London market?
Well, I have backed US companies. In general, I've worked in the private markets because I like to be able to have a say over leverage, for example, and executive compensation, and how CapEx is spent. And Rose is our first public venture. We got into this because of the valuation gap that I talked about in the presentation. I like it enough that I've made it my full-time job. It's really hard to find a combination of a clean platform with no debt, no liabilities, that's trading at such a substantial discount to what I perceive as the potential value. So, we saw it as a pathway for a really low risk entry into a way that we could make many multiples on our money if we do this in the right way. We have massive tax benefits that we can utilize as well going forward. So for me, this was a one-of-a-kind opportunity. We did a lot of homework before getting into it. We spent a lot of time positioning it in the right way. But for me, this is absolutely the right path forward.
Yeah. How aligned is the board with other investors, and how much have you and your colleagues invested to date?
So we've invested $1.5 million of our own capital. So I would say that's highly aligned with other shareholders. We certainly spend a lot of time and effort communicating with our shareholders. Our value will come when we deliver growth in the share price. And so to me, that's the best kind of alignment that you can have.
Yeah. Another one here. Great that you have grant funding on the drilling. If successful, what are the key fiscal terms on the license should you go into production?
So we have a combination of state leases and federal leases. But if the question is about royalty rates, generally they're 12.5% on these leases. And the other thing that happens is when you go into production, you can form a unit around that from lots of other leases, and those will be held in perpetuity as long as there is production from one part of the unit. So the long-term plan will be start producing, unitize this, and then in terms of time on the leases, that really becomes a non-issue because you'll have lots of running room going forward.
Yeah. Talking about sort of general oil sentiment, and I know, especially now, Biden's coming in, and there's been a lot of people sort of down on oil, and you see sovereign funds sort of divesting and all that stuff. What's your thoughts? What's your stance there? And to a certain extent, there's a good play here because to a certain extent, everyone that can sell is probably out, I suppose. So it's a good investment. And I can't see, and I suppose, a lack of investment in exploring, and yet demand is still slowly creeping up.
Yep.
It's a good place to be for. Well, I don't know how long a time frame, but what's your thoughts on it?
Well, there are lots of ways to address that. We're certainly bullish on the sector right now. We think demand will come back. Even without that, our break-even costs, particularly on the Paradox, are substantially lower than where we are right now. So, this is why we're actively moving forward. We think we've got a great project even in this environment. In terms of the sector as a whole, I think you can divest from it completely, or you can choose to engage with it. And as an individual and as in a management team, we are divesting and we're engaging with the industry completely and trying to bring best practices to it. And that leads on to your comment about Biden. I think it's fantastic that we may have a bit more stability in our sector. We don't run the risk of waking up to a tweet that has started a trade war, which has just provided a more volatile environment for operators, similarly on a regulatory front. We'd like straight guidelines, which we can work within. I don't mind guidelines at all. I just like a level playing field. So I think overall, when you look at a Joe Biden, a lot of his votes come from states like Pennsylvania and New Mexico that delivered him the election, and also are big oil producing states. So I think he will, be an ally to the industry. I think we'll have some stability. And more importantly, as a natural fracture play, if his government is looking to highlight projects which might be considered to be more environmentally friendly, I think we're incredibly well positioned. So I feel good about where we are right now, and I'm very excited about the coming year.
Yeah. Now, one final one. Are you looking at securing the remaining 49% of the iron ore asset from Winfield, who are one of your major shareholders?
If I knew what any of those were, I could tell you, but I think that might be a question for a different company, unfortunately.
Okay, I think someone has a name. Yes, Colin, I apologize.
Let me close on that note. We are highly focused on oil and gas development in the Rocky Mountain region. We are singularly focused there. So the answer is no to anything else. We're going to do.
Yeah, that was my fault. It just came on the group then, and live thing. That was for somebody else, I think, some different WhatsApp group. There we are. Colin, thanks very much. Listen, have a great day, and it's not hard to have a great day when you start off the day with weather like that. When you get up into the rain and it's cold and it's dark, it's a lot harder. But have a nice day. Thanks for joining us, and speak soon.
Thank you for everybody's time tonight. Really appreciate it. Thanks, Justin, for the help.